Hey, Mario, it's great to see you for another quarterly presentation about what's transpiring here.
Thanks, Bob. Good to see you too.
Yeah, so just to give everyone a brief synopsis as to what it is that we're about to do here, it's Novi Wealth Partners and East Bay Investment Solutions, who East Bay and Mario Nardone help us out with our research and implementation on our investment solutions here at Novi. And each quarter, he's kind enough to bring us up to speed on what's transpired over the past quarter and just what are some of the things that are that the global economy is taking place in the global economy. And by no means are we looking at this as a way to prognosticate or predict the future. It's just to get a pulse on what's going on so we're aware of the dynamics that are taking shape. We still do have to do financial planning and investment management for our clients. So it's extremely important we have these elements. So Mario, with that intro, I'm excited to hear what the second quarter had to hold for us, and just catching up with you. So please get us started here.
Absolutely. Well, there's definitely a lot to report, a lot to digest. All right. So I think the most important thing, if you've paid attention at all to the financial media, you know that there are some key buzzwords out there, and a lot of the news is really, not that favorable. So we're here, primarily because we don't want everybody to be steeped in this doom and gloom. We always know that there's some glimmers of hope, some reasons for optimism, and we try to call attention to that up front. And we list a few of those on the left. We hear a lot about inflation. We're going to talk about that. That's certainly one of the things on the concern side. But that second bullet point there showing us that unemployment is still at only 3.6%, which is about as low as it's been in 40 or 50 years. That is clearly the sign of a strong economy and one that could possibly weather some of the required moves that the Fed and the government need to take to keep inflation in check. So there are some reasons to be optimistic. The bottom bullet point on the left talks about the bond market. We have bonds in our portfolios to provide stability. And now that there's been a little bit of a pullback in the bond market, that means that there's a bit more yield to be achieved and income to be received on the bond side of our portfolio. And I'll end with the top bullet point on the left, where if you think about an unemployment rate at 3.6%, to me that sounds a little better than pretty good. But if the Federal Reserve is saying we're in pretty good shape, that's pretty good, considering all the other negativity that we see out there. On the right side of the page, the top bullet point there is the big question for the Fed. You see those quotes surrounding the term soft landing. The definition of a soft landing is that we can keep inflation in check while not dipping into a recession. And then the second bullet point is that the Fed really only has so much power. They might be able to, manage interest rates to keep our domestic demand lower, but it really doesn't have any tools to create or to solve the supply problems that are elsewhere in the world. And most of them, as you see on the page, are a result of China's COVID shutdowns, creating supply chain disruptions, as well as the war in Ukraine, causing price hikes in the energy and food markets. So with that, let's get into the meat of the presentation. I already mentioned inflation, so let's really take a high-level view of what the inflation picture looks like. This is a familiar slide. If you've tuned into these presentations before, it shows you the path that inflation has taken since the 70s. And let's focus on the darker line that represents core CPI. It's a little bit less volatile due to excluding oil prices. Nonetheless, you see at the far left, very high inflation in the 70s and early 80s, then a moderation of inflation through the 90s, and really sort of a benign inflation environment for the majority of the last couple decades. But then you look at the far right and you see that recent spike. And when you think about the fact that those, depending on the measure you're using, inflation between 6 and 9%, that's setting off some alarm bells when you consider the Fed's target is about 2%. So that's really why the big deal right now. And if you look at the inset, these numbers are through May. The June numbers have since come out since we published this, and they're even a little bit higher than on your page. The expectation back in April is that inflation had peaked at around 8.3%, but we keep marching higher, and those expectations are now a little bit uncertain. The key takeaways here, if you look at that blue number at 8.5%, now not closer to 9%, two rows down from that, you see food inflation, which is a result partially due to the situation in Ukraine. And then below that, absolutely a result of what's going on over there in the energy CPI, or energy inflation. Essentially, the price of a barrel of oil is up 34%, or 40% if you look at the June number from a year earlier. And that's absolutely hitting us at the gas pumps. It's hitting us with everything that we want to buy that has to go over the road or over a cargo ship. And that's why that is such a big deal that we're all watching today. If you did pay attention to the financial media going back to the middle of 2020, you may have heard the Fed start using the term transitory, which is really a synonym for temporary. And we now know that inflation has not been as temporary as they originally thought. But what JP Morgan did with this slide, and we showed it last quarter too, I thought it was pretty good. On the right side, you see some categories that are contributing to inflation that could be deemed stickier, and those that could be deemed as transitory. And if you look at the overall inflation figure, it looks like it's split pretty evenly. And if JP Morgan gets this right, I think the thing that we all kind of need to think about is that even if those transitory inflation factors do go away and their contribution to inflation goes to zero, you still have the sticky factors contributing about 4% to inflation. And if you think about how long it took on this chart, we go from the far left, which was March of last year, those sticky contributors only amounted to about 1%. And fast forward to today, it's about 4%. It may take at least that long for those stickier factors to come back to earth. So I think, we don't make prognostications, but we do err on the side of conservatism. And even if the Fed can get it right, I think we probably should be expecting inflation to stick around a little bit longer, considering how sticky it's already been.
Yeah, well, one of the things I want to say about not trying to predict the future around this kind of stuff is we do, when we're doing some planning, we're going to look at the client and their particular situation and how any of this information can impact them. So, and how it'll affect their lifestyle and their cash flow and the planning circumstances, whether it be their current age and their needs, or their employment and the companies that they work for, or if they own their own company. So that's more the dialogue that we would be having with this type of information, which is extremely important to be aware of. So,
yeah, absolutely. It's a great point. If you're a renter, the contribution of rent to inflation today is a much bigger factor than, if you're not in a prospective home buyer, right? So you're absolutely right. That is a personal,
and this is significant the increase in rents. And I know I've spoken to people firsthand that have rent issues. But if you own real estate, it's a benefit, especially if you had been leveraged and you had low interest rates. Now you have the opportunity. Trust me here, I am not pushing people to get into real estate at this point. I'm just saying that there's the cost to pay that note with the increase in the rents that you can get becomes very profitable.
Yeah, absolutely. So at a micro level, what you just said is very appropriate, that inflation is different for everybody. But ironically, this next slide talks about how similar it is for everybody around the world. When we talk about the Fed, we think about inflation as a very US focused issue, but you don't have to know what every bullet or data point on this chart represents. But if you look at the far right, you see inflation figures for major countries and regions around the world. Red meaning inflation is running hot, and you can see that it's fairly consistent, with the exception of China, which we know has forcibly shut down its economy to get COVID under wraps, and Japan, who's notoriously in sort of the economic doldrums. So, but other than that, inflation is a global issue, so we can't really just think about what the Fed can do. It's really it really has a lot to do with geopolitics. So this is an interesting chart, and it really is a tale of two consumers, if you will. Typically, we think about something that does tell us a little bit about the future is consumer sentiment. And when consumer sentiment is low, that means the consumer is expecting a soft patch and generally likes to play their personal finances closer to the vest, and they start saving a little bit more. And so what we're actually seeing today is a little bit of a disruption in that relationship. And these colors are a little too close for my liking, but the green one represents consumer sentiment going from 2019 at the left to today at the right. You see that consumer sentiment reading, at least this particular definition, has been cut about in half since its high point. So consumers are less confident today of the future than they were 2 years ago. But on the flip side, that blue line, shows actual consumer spending, and it continues to go up. And that's very atypical from what we typically see. And the reason for that is what's being attributed to it is that we do have low unemployment. We've had some wage growth for those people that do have jobs. And when all that stimulus was being pumped into the economy, what we saw is a lot of US consumers were saving that stimulus. Consumers hadn't saved as much in decades as they did during COVID when we were getting stimulus checks. So there's still some of that savings to be spent. And that's all part of the reason why the Fed and others think that even if they do try to tighten the belt buckles to get inflation in check, our economy could possibly have the resilience to prevent a recession. As far as that recession talk goes, I mean, just to sort of front run the question of are we in or are we going to be in a recession? We don't make that call. There's a particular organization of economists that are the ones that technically give us the definition and whether or not they think that we're in a recession. However, this is a really interesting historical view of the relationship between bond yields and the likelihood of a recession. Not to get into too much of a detail, but generally speaking, when there's a flat or inverted yield curve, meaning short-term bond yields are higher than intermediate-term bond yields, that's a little bit of a warning bell that there may be a recession looming. And so what Piper Sandler did a study historically of when we've at various yield spreads, which is the left column on top, tells us what's the likelihood of a scenario in the next 1, 2, and 3 years. At the time of this chart, the yield spread was around 6 basis points. So if you look at that, the number 5, let's circle it here if you can see my cursor, then historically, when we've had that shape of a yield curve, we've had a 22% chance of recession in 1 year, 62% in 2 years, and 81% in 3 years. So we're not saying this is going to be true. We're not saying we hope, totally believe that it's, even that important to know if we're going to have a recession. But if the questions are being asked, this is a pretty, I think, historically accurate way to answer that question. So let's talk about bonds. I talked up front about increased yields in the bond market. And the reason why we have increased yields is because we've had a pullback in bond prices. With the Fed at the beginning of the year announcing a very determined effort or interest in getting inflation in check, expecting to raise interest rates throughout this year, if not into next year. Well, that all bodes fairly poorly for bonds. If you're a bondholder owning a bond at last year's yields, and you can buy a new bond at a better yield this year, well, that's going to reduce the value of those existing bonds. So you see across the board, with one very little exception, we'll talk about that in a second, we have seen a pullback in the bond market. That exception on the top right is for inflation protected bonds, which had a positive 0.4% yield solely due to their inflation adjustment. Now, the one thing I'd like to make sure we point out is that even though inflation protected bonds, also known as TIPS, should protect you against inflation, they are still subject to interest rate risk. And so if it weren't for that interest rate risk, the performance would be even better, but they do still behave like bonds. And we do need to understand that relationship.
A couple points I just want to make about that real quick, Mario. When we talk about the financial planning aspects associated with this, a lot of our clients are retired or near retirement, and their investment allocation may have a fair amount in bonds, in fixed income investments. And when we do our planning, we're looking at what's called the real return. So it is the return of a portfolio after inflation is considered. So, and we typically look at it as a long-term perspective, not the short-term exposure we're seeing today, because it's likely, well, who knows what'll happen with inflation. But I'm hoping that the measures that are being taken by the Fed and the economy as a whole start to bring it into something that we've become accustomed to and used to. But with that said, what'll happen right now is, like you said, the drop in the price, the returns here that are negative is because of the rising interest rates. Well, that is a benefit in the long run to savers to normalize that real return, the matching of the inflationary number. So if inflation, is up around 5-6% or somewhere in that ballpark, I know it's year over year right now. I think, like Mario was saying, I think it hit 9.1 as of June. But if we can get the returns on the fixed income, then we're narrowing that margin on the real return, and the savers that have a large amount in fixed income are getting much larger coupons from the bonds that they own. So it's a painful situation to start out with, but many people, these bond managers are doing what they can to maintain the holdings. And then also at the same rate, if they do hold a bond to maturity, remember, it still pays full face value. So the bond will not be losing it. We're typically working with high quality bonds, so we're not looking at any kind of default issues or anything like that. So I just wanted to say how we interpret or look at this type of information and how it would pertain back to the planning perspective.
Yep, very good. And obviously, if there are any follow-up questions about your particular portfolio and how it's positioned, we're happy to answer that.
Exactly. Thank you.
Obviously, we're not used to seeing negative returns on the bond side of our portfolio. We just discussed that in detail why that is the case. But if you wanted to put it in perspective and not to really express that doom and gloom in more detail, what we have here are the 6 worst quarters for the US bond market since 1980. And if you look at those 2 highlighted numbers for the first and second quarter, you see that those are 2 of the 6 worst quarters on record. And if you look at the one on the right, which is the first quarter of last year, you see that we have, 3 out of the worst 6 quarters have occurred within the last, 18 months. So this is really unprecedented, but I think I would just echo what Bob just said and say, look, I would rather have a small period of pain and see the price of my bonds go down so that I can earn a higher yield in perpetuity until my holding period or until my investment horizon is up. And I think that's the silver lining we need to take away from this. I'm not going to belabor this slide too much, but the red dots basically tell you that within any calendar year, we have seen a pullback in bonds. And this goes all the way back to the 70s. But the gray bar indicates that despite those pullbacks, the vast majority of times we still end up in positive territory at the end of the year. Now, the observation at the far right, which is where we are year to date, is deeper of a pullback than we've seen before. So will we get back to even? We don't know, but it's that increasing yield that helps you get back there. And considering all the negative news that is baked into market prices, anytime we get favorable news, whether it's Ukraine or China or COVID or whatever, there's a good likelihood that we will see those impact, influencing our investment prices back to normal levels. Not saying when that's going to happen, but I'm an optimist. I like to think that all of those things will be resolved in due time.
Yeah, one of the things I have to say, there's a major volatility taking place in this circumstance, and just talking about people attempting to time the market. There's plenty of times that we go through this thing called the Callan chart, And I think you have a slide potentially towards the end of the presentation. I don't know if you intend to spend much time on it. If you look in the far left here, 1980 maybe, there was a 9% intra-year decline. And then a few years later, there was this massive improvement on the bond side and the returns. And I'm not using that as a prognostication of what's going to happen, but all I'm simply saying is, if you're going to time the market, you got to time it twice, and you better know when to get out and get back in and so forth. So if history's any lesson, it's not a good idea to try and predict what's gonna transpire going forward. And on top of that, you've already endured the pain of a 10% loss so far year to date. That why would you lock in that loss at this point if you're a long-term investor?
And to follow on to that, bonds, the question that everybody was asking is whether or not bonds still maintain that diversification benefit. And, in reality, if you look at this from a mathematical perspective, bonds actually are positioned better today to offer that protection if stocks decline again than they were at the beginning of the year.
Okay.
So if you believed in bonds for that purpose, then I would not, let that philosophy get rattled based on the experience so far year to date. And there's a lot on this chart. I've talked about yield curves before, and that right here you're looking at 13 different yield curves. I'll use this chart really for one major takeaway, and that is in the top left section. Basically, what we're looking at here are the yields on various maturing treasury bonds. So if I focus on the 5-year, this line at the bottom here was at the beginning of the year. So the 5-year treasury was paying a little more than 1% as of December. And if we were an investor in bonds, that was what we were expected to receive from that holding. Well, that bond sell-off now means that the 5-year bond as of the end of June is paying over 3%. So that's sort of just to illustrate that relationship between bond prices and yields. And the only other thing I would say based on this page is that treasuries aren't the only other kind of bond we own. It's hard to see because the scale of some of these are a little bit different. But you could see that if we own municipal bonds and understanding that their income is tax-free, well, they're giving us a different yield profile. And corporate bonds are giving us an opportunity to get even more yield. For instance, the 5-year corporate is yielding around 4.5%. So when we like to have that mix of bonds in our portfolio to make sure that we're not overly exposed to one risk factor, whether it's credit risk or interest rate risk. As far as municipal bond goes, I'm not going to spend too much time on this page, but this spread column, Bob, this is really interesting. This is telling us that the tax equivalent yield of municipal bonds for somebody who's in a 37% tax bracket at the 10-year is paying 138% the yield of treasuries. Yep. So this just goes to show you that if you have a taxable portfolio and you're using municipal bonds, you can actually enhance your expected yield by diversifying into those categories. And this is pretty much unprecedented territory. Muni finances are as strong as they've almost ever been. If you listen to the investors that we follow and utilize, unlike the great financial crisis when a lot of municipalities had some fiscal problems, they're actually in really good shape. The issue is munis were sold the same way that other bonds were sold so far this year, and that just makes their yields that much more attractive.
Yeah, as I think we spent a lot of time on net after-tax return for our clients in many areas of planning, and where a lot of investment advisors, it's all strictly about return and what the outcome is. This is a big part of what we deliver on.
So enough about bonds. We'll talk about stocks, which unfortunately you see, some negative numbers on the page, and actually the stock market has broken some pretty dubious records this year too. In fact, the S&P 500 is off to its worst first half of a calendar year since 1970, being down about 20%. That being said, the S&P isn't the entirety of the market. And you can see that different segments of the market have performed differently. And in particular, the large cap value segment, which is the orange bar, fell the least. And as you know, obviously we're finding silver linings here. We do tend to lean towards the value side of the equation. So that has insulated us a little bit from the pullback we've seen so far. And I think the big takeaway from all of this, and we're going to get back to the nuances of the stock market, but I want to maybe overlay some poor pessimistic news with some optimistic news. If you have a long enough holding period, historically we've seen stock market declines, but you end up in positive territory simply by staying put, not trying to time it, not trying to sell out when markets are at their bottoms. And if you look at the 10-year chart here, you see that since the Great Depression, now that's depression, the 1920s, we've only seen 6% of 10-year periods where the stock market wasn't positive. And if you've just extended your holding period to 15 years, there was never a time period where stocks were negative. I know that sounds like a long time, but that is certainly well within the expectations for most people's long-term horizon.
Mario, I should have requested that you update this this slide with what most of our clients experience, and that is in a diversified portfolio, because just at the 6%, I don't know the lost decade from 2000 through 2009, the end of 2009. I think a diversified 60% equity, 40% fixed income portfolio, it was global, was a little over 6% annualized return, So, having money in all different places in different asset classes makes a difference. And I think you're going to wind up getting into, different areas in the market before we're through here. So thank you. This is a good refresher, but having bonds, having international and having domestic will help mitigate even that 10-year period where the 6% of the time it was negative.
So getting into a little bit more detail, I talked about value versus growth, right? Value doing a little bit better than growth. Now let's dive into the sectors. If you look at the top, this is the S&P 500. This is the contribution to return, that's negative 20% return year to date for each sector. We know that oil prices are up. That's generally good for energy stocks. That's why you see energy being the only positive performing category within the S&P. In general, we see value-oriented categories at the top of the page: energy, utilities, staples, all of it. All of those are generally value-oriented investments. At the bottom, you see technology, and the third from the bottom, you see telecom, essentially. They're among the worst performing sectors. Those are your more growth-oriented investments. Yes, they've done a little bit better in previous years, but you do see that, sort of like bigger they are, harder they fall kind of story. And you'll see even further on the next page that you have some of the most popular growth stocks of recent years have actually kind of taken it on the chin. In particular, you see Meta, which is Facebook essentially, and Netflix at minus 52 and minus 71% returns. And the real surprising thing this quarter is that decline in value relative to their earnings and earnings potential have actually put Facebook and Netflix into some value-oriented categories and value indexes. And that's sort of hard for people to get their head around, thinking these big tech stocks are always going to be growth names. It's just not the case today. And sometimes market prices do come back to earth, right? It's not always this euphoric belief that tech stocks can keep growing forever. And that's why we don't put all of our eggs in that basket, quite honestly. A lot of people want to talk about commodities today. Anytime you see inflation picking up, the commodities question really starts to come into play. And yes, there are some types of economic environments where commodities are an inflation hedge. But what we really want to emphasize is that because we take a long-term approach, we think about how commodities are expected to impact the risk and return profile of a portfolio over the long run. And on the left side of the page, the green and blue lines represent $100 put into two different commodities indexes on January 1st of 2005. If you look at the blue line, that tells you that the Bloomberg commodity index, if you had invested in that basket of commodities, you would basically be breaking even on that $100 that you invested through this year. If you use the S&P commodities index, you'd actually be in negative territory. So the question is whether or not the diversification benefit and the temporary inflation hedge that commodities provide are really worth it, especially when you compare to that orange line, which represents $100 put in the S&P 500, which is worth about $450 today, despite the most recent pullback. And on the right side of the page, you kind of really dive deep into what's going on within commodities. Yes, we look at it as a basket, but in reality, if you look at the top few categories, you see it's almost all energy related. It's not a broad-based commodities rally, if you will, or hadn't been a broad-based commodities rally, which you would see if it were an inflationary environment due to global expansion. So we need to make sure we understand what commodities could or couldn't do to a portfolio. And in general, we just stay quite leery of that category.
Yeah, Mario, let me just touch base before you switch sides here. Before we started working with you years ago, we had commodities as a part of our portfolio. And it was exactly for this reason. We're looking for additional ways to diversify a portfolio. And what I mean by that, if stocks are going up, and then maybe, bonds, a lot of times, certain like long-term treasuries can have what's called is negative correlation, which you're familiar with. But that means that if stocks are going up, those long-term treasuries might be going down. So they're acting in opposites, but they both have returns over time. It gets complicated, but the point was we thought we could add commodities to the portfolio to provide some of that benefit. And there's two drawbacks to having commodities from an investor standpoint. One is they don't produce anything. You are just a participant in whatever people are willing to pay for that particular commodity at any given time. We want to invest in people that are taking these raw materials, have an idea or have a service, and turn it into a profitable entity. So we'd rather purchase companies or have investments that will get that kind of exposure. The second thing is inflation doesn't rear up like this, semi-annually or every couple of years or so. It can be long periods of time. And if you're sitting on these commodities, most investors are not looking at things over a 25-year horizon or a 15 or 20-year horizon where they're saying, oh, I can wait for that underperformance during that time frame for it to kick back up and be a little protector. That may be better suited for hedge funds or pensions, endowments, people that have 100-year investment horizons. So I just wanted to give my 2 cents on why we do not incorporate commodities into our portfolio at this point. It's a drag in our mind on performance for the potential benefit that doesn't fit with our typical investor.
So we talked about U.S. stocks and the negative year so far. Same story for stocks outside the U.S. Bob just mentioned international diversification. It doesn't mean that when U.S. stocks are down, international stocks are going to be up. They still represent equity ownership of companies, and we should expect them to generally move in similar directions, especially when we have such a global issue going on right now. Nonetheless, I think the biggest difference between the last 12 months, which are on the right side of the page, and more recent periods are that over the full 12-month period, you see emerging markets, that yellow bar was the worst performer. But so far this year, you see emerging markets actually holding up a little bit better than their counterparts in the more developed parts of the world. And again, there's a lot of conversation all the time about whether it's worth it to invest in emerging markets. Are they stickier? Are they riskier? I should say riskier. And the answer is that they still provide a different performance profile. And we do think that they belong at least to be a part of your portfolio. And the other factor that we have to address at any time we want to look at what's going on in international markets is the impact that the US dollar has played. And if you look at, we try to show this chart as much as possible. That top one shows you the path that the dollar has taken essentially over the past 20 years. For the first part of that period, you see the dollar had declined against a basket of global currencies. But since about 2012 or so, the value of the dollar has marched back higher, almost without interruption. And the reason we bring that up is because if the dollar appreciates, and you could see articles today about Americans going over on spending sprees in Europe because of how strong the dollar is. And yes, as a consumer, that's great for us. But as an investor in foreign assets, a stronger dollar actually hurts us, because in order to buy that foreign asset, we actually had to transfer our dollars into foreign currencies. And theoretically, when we sell those assets, we have to transfer back. So if the dollar strengthened, we could buy less of those dollars back. So yes, that has been a drag on investments in ex-US stocks over the last 10 years or so, but we can't expect that to last forever. You see the left part of that graph I just mentioned. If the fortunes of the dollar turn around, we're going to be very glad that we have that non-dollar asset in our portfolio, especially to help with that consumption side, which at that moment we would be disadvantaged.
Yeah, Mario, I didn't think I was teeing up, but this goes back to the conversation where you showed the slide of the 1, 5, 10, and 15 years of underperformance, or when a market's negative over a 10-year, over those different time horizons and the percentage of the time. And I just threw out the idea that a globally diversified 60% equity, 40% fixed income portfolio averaged over 6% annualized return. Well, a majority of that return was from international investments. So again, you do not want to ignore the diversification benefits of those foreign assets and the potential benefits of outcome. And there's also rebalancing opportunities. There's a whole host of reasons why you keep those as part of your portfolio.
So I don't know how often you guys talk about crypto, but I thought this was a great opportunity to acknowledge the craziness in that particular market. Here we use Bitcoin as a proxy. It's the one that most people know about. And, up until this year, and most importantly, the previous 2 or 3 years or so, we started to hear about how Bitcoin was going to be a new reserve currency, or it's going to be the next digital gold, meaning when investors are no longer enamored with stocks or bonds, they're going to put their money in crypto the way they used to put their money in gold. But I think this chart proves that it's definitely not the case yet, if it ever is going to be the case. Because, as you could see, in a period where stocks and bonds were selling off, we're seeing, Bitcoin going from $46,000 per coin down to below 20,000 on this page. And if we extended this chart back to November of last year, if you recall, Bitcoin was up over $65,000 per Bitcoin. So, it's things like this. And until this particular cryptocurrency craze figures out what it's going to be, is it going to be currency? Is it going to be a store of assets? We still consider it to be highly speculative. We don't think it's an asset class that is needed in every portfolio. Some investors do understand it more than others, and if they want to dabble or whatever, then it's our job is really just to make sure that they don't shoot themselves in the foot and over allocate to categories like that. The same way we wouldn't suggest taking too much of your portfolio to Las Vegas or Atlantic City, which might be closer for your clientele.
Yeah, I'm going to throw one more bit of color to this, Mario, is the fact that we just talked about, you just compared it to gold, and we talked about commodities before, and gold is a commodity. As much as it provides a diversification benefit, it does not provide any value other than whatever somebody prices it at that given day, versus somebody that may, for let's say some reason, need gold for production of a transistor or some product that they may create. So, crypto, if they're going to compare it to gold, that in itself then puts it on the level of saying, well, what is the value? Why would we participate in something like this when it's just a currency? And on top of it, we do not play with currency. We don't deal with currency manipulation other than when we have foreign bonds. I don't want to dive into that, but we hedge the exposure associated with that to avoid, or the management companies that we use hedge our exposure, so we're not dealing with currency changes associated with this. But I'm just going to jump on the bandwagon here, Mario, and say, if people don't turn your nose up to the bad news, there's been lots of bad news associated with cryptocurrencies and people losing significant amounts of money. And I will give one other warning. The financial markets are regulated. So that is your investments that are held at Charles Schwab, in your case, for the most part, the people that work with us, those entities have all types of protections in place. If you own a cryptocurrency and you're not using your own personal wallet and you're using something like a Binance or Coinbase or whatever these other institutions are, read your agreements closely, because the assets that you have that you believe are on their platform and you believe to be your own, there's a very good probability that those assets are actually considered to be used for the creditors of those organizations. So it's not necessarily your money. So just be careful about how you, if you're going to dabble in this, how you go about and implement it and understand your outcomes. And again, like Mario said, it is entirely speculation. So that's it.
That's absolutely great advice, Bob. And there's a lot going on out there, a lot of misinformation. I would say that if you're getting information about crypto, get it from the more reputable and well-known source, the better. Because a lot of times what we're seeing are folks with ulterior motives, right? They present themselves like a newsletter or a well-researched white paper, but really they're just trying to drum up interest in their own product. So if you're trying to learn about it and interested in a second opinion, just let us know. We're happy to take a look at it. There's a decent chance we've looked at it before and we could just better help you understand what it is. Bob, you want to take it from here to talk about, what we want to focus on from a financial planning perspective?
I'd like to bring this to an end, and anyone that stayed here this long, that's fantastic. And I have one thing that I'd like to share with everyone before I go through the principles that we focus ourselves on. I try to give Mario, previous to this presentation, a thought that I had around investing. And anyone that's ever gambled before, which I am not a gambler. When I was in college, I had a friend that took me to a bar one time that had 20 TVs, 30 TVs on the wall, and he said, in order to get engaged, you should place a bet. And so I took, let's hope this does not put me in jail somewhere, but I took $50 and I did what's called a parlay. So I bought I gambled on 4 different teams, but in order for me to win, all 4 teams needed to win. And the reason I did it was I could make that $50 bet. And if I bet just on one team winning, I might make $25 on that $50 bet. But the compounding of the bet, if I win the next game and the third game and the fourth game, that $50 could wind up being worth almost $1,000 or some ridiculous amount of wager, because the probability and likelihood of getting all 4 games correct is really, really hard. And so what I'm getting at here real quickly is you go through this and you see all these different bits of information that Mario shared with you today. And it's only like scratching the surface of what's out there. People that are attempting to prognosticate the directions of the markets is basically taking a parlay. So, you better have enough information to be able to gamble on all those different bits and determine the outcomes. And so if you're not that gambler that's willing to do a parlay, give us a call. That's an area that we can help you, show you how you can be successful without having to gamble your belongings and your investments. So what should you do? Like the slide says here, financial planning is a process. It's not an endpoint. It's an ongoing objective that we partake here. I'm not going to dive into each of these, but behavior is a huge part of it. Knowing your needs and circumstances, and doing it in a cost efficient, tax efficient manner is extremely important. These are all things that we ensure we provide. Farewell, and thank you all that listened this far along. It's been a bumpy year and quarter for the investment markets, but know that East Bay and Novi Wealth are here to answer any questions and make sure things are going the right direction for you.
Thanks, everybody. Thanks, Bob.
Thank you, Mario. Take care.
All right.